If you've been keeping track of what's going on with the Fed's meeting over the last couple of years and leading up to the one that we just had this week, you might be asking yourself, and with confusion, why did the mortgage rates go up instead of coming down, even though the Feds cut the rate by 1/4%? I want to explain to you exactly what the reason was behind this, so that way exactly where things currently stand within the economy. So the Feds, they cut it by 1/4% because they actually rely on the data of the job market. And because there was a massive revision over a couple of weeks ago showed that the job market was weakening, they actually reduced the rate. Now, with that being said, mortgage rates aren't in correlation with that. They are relying on the inflation data. And because the inflation data is still above that 2% number that the Feds want to see it at, lenders actually ended up raising up the interest rates on the mortgages to protect themselves. So what does that mean for you? If you are a buyer who has been wanting to purchase a home, rates did come down over from what they were last year, and you're saving a couple $100. And also, with that being said, rates are expected to continue to come down slowly and gradually. And as they do, usually the competition will spike up because it increases affordability for homeowners. But if you are a seller, what this means for you is that if you've been thinking of selling, or if you have your house on the market or know somebody who does, it's not going to create a frenzy of buyers that are going to line up at your door ready to purchase your home. There's still a lot of uncertainty, which is keeping people on the sidelines. So with that being said, I hope that really clears the picture up of exactly what happened this week during the Fed meeting, so that we know how to move forward as the Feds continue to have these meetings and we continue to see how things progress in our economy. I'll continue to keep you guys updated. Have a good day.